Vikas, come to you. Dissect the oil story for us. Which way are oil prices headed, and how do you see its impact?
So oil prices heading will largely depend on a couple of factors that we can expect to evolve over the next month or so. The first one, the big one, would be the meeting of OPEC in mid-June, where they will take a call on the production cuts that they have in place and whether they should increase, continue, prolong those production cuts. That will determine the direction of oil prices from here. The second factor, of course, is the Iran sanctions and the developing situation in Venezuela, because these are things that are not really very predictable. How the Iran sanctions will play out, who will join the sanctions, who will not join, how will countries get around those sanctions to get the crude oil. So those two factors, in my view, will determine the direction of crude oil. Until there is clarity on that, we expect crude oil to stay at current levels, relative stability from the volatility that we have seen over the past couple of months.
Because my next question to you is that how would you assess the health of Indian OMCs? We saw a big structural reform in the oil sector 2-3 years ago when oil prices were deregulated, and that was an easy reform to implement because it also coincided with a drop in crude. But now is the testing time. Now is the time when one side you've got the health of oil marketing companies, on the other side you've got inflation and the consumer interest. So as an outside observer, your view on OMCs, is that constructive or is that cautious now?
For oil marketing companies, whenever oil prices go up, there is challenging times, not just in India. Even if you look at refiners globally, oil prices going up means two things. One, the refining margins come down, and two, your working capital requirements go up. So inherently, oil prices at a high level is a challenging environment. On top of that, what has happened in India is you have a little bit of uncertainty around how they will implement this price deregulation, although we have not seen that happening on the ground yet or having an impact on the health of oil companies. In fact, all the oil marketing companies have reduced borrowings over the last couple of years. The credit metrics have gone better, and the only bit of downside that we have seen is the increase in dividend that they've been paying over the last 2.5 years, which has gone up. But other than that, the oil marketing companies remain in good health. Credit metrics remain strong. There is outlook for them is, of course, margins will come down. In the election year, we don't know how much of marketing margins they will be making. Possibly, we can expect the marketing margins to be a little bit lower. We've already heard the IOC chairman to say that they're not going to use marketing margin to increase prices. They will probably absorb a little bit of that. So overall, the earnings outlook for the oil marketing companies remains weak as long as oil prices keep going up, refining margins come down, marketing margins come down, and possibly working capital going up. So we'll be cautious on the credit metrics of the oil marketing companies.
Are you a little more optimistic about the upstream companies, ONGC and all, because of the correlation they have to oil prices?
So we published a report yesterday where we outlined what's going to happen if the government asks upstream companies to share subsidy burden, for which the risk is increasing now. The government has limited fiscal space, and more so if they cut down excise duty. That will reduce the fiscal space for government even further. But that's excise duty on petrol and diesel. There is already subsidy on LPG and kerosene, which will continue to increase if oil prices stay this high. So government has only budgeted around 250 billion, out of which they are already paying about 90 billion in the January to March quarter. So that gives them very little to absorb in terms of subsidy for LPG and kerosene. And if they want to maintain the fiscal space or do not stretch it further, they are going to have to ask upstream companies. Now, if for the upstream companies, even a $60 oil, if the government asks them to take the entire shortfall, that means $8 discount. At $80, that discount is $24 for the upstream companies. So effectively, they're not going to be making too much more than what they made last year, even if oil prices go up. Typically, for upstream companies, we will be positive around oil prices going up. In case of India, we think that the improvement is not going to be that good, possibly a little bit of deterioration from last year if the government actually passes on high fiscal subsidies to them.
Well, thanks, Vikas, for joining us and sharing your view on markets and some of the sectors which we discussed with you. Hope to see you again and listen from you about markets.